We're very much bottom-up fund managers, so we look at it at an individual stock level. But where it sort of comes through are the economy, the countries we like, or the stocks we like, tend to be based in places like Brazil, India, Indonesia, Malaysia, Singapore, these sort of countries, as opposed to, say, Russia and China, because we still find it quite difficult to find companies we like in Russia and China, mainly for corporate governance reasons. But that will change over time, and there's some very good companies there. And as corporate governance improves and we get the feeling that management will look after our interests as a minority shareholder, we'll invest money there. The vital thing about emerging markets is spending time on the ground, having offices in the various countries that you emerge, and having fund managers there, visiting the companies, meeting the management. Emerging markets really do need bottom-up research based on the ground, or else you can make some terrible mistakes in that area. I think one of the great sort of fallacies about investing is people invest in indices rather than stocks. And whether it's emerging markets or developed markets or frontier markets, you've always got to get back to that basic precept that you're investing in stocks rather than indices. And there's huge disparity in performance of an index between stocks that do well and stocks that do badly, which is why we, as an active fund manager, tend to do well in all stock markets around the world. I think our favorite sectors haven't really changed over the last 10, 20, 30 years that we've been doing this. We like emerging market banks because of the simple business model they have. We like basic consumer good companies. We like the Heinekens of this world, the Unilevers of this world, those sort of companies. We just keep it simple here. We try and find good companies and invest in them and hold them for the long term. We've held some of our companies in our portfolios for 20, 25 years. And I think that's the basis of all good investing. Just find good companies and hold them. I think that banks have still got quite a way to go in the developed markets. We hold about 30 banks worldwide, of which we hold about 25, over 5%. They're all emerging market banks. And the reason we do that is they've got a very simple business model. They lend money to people who are going to pay them back. They have more deposits than loans and tend not to have a big investment banking arm. And I think that what we've got to see in the developed market banks is a return to that simple business model. So for instance, in the UK, I would say that Lloyds Bank is probably the front runner in that getting back to a very basic business model, whereas something like RBS is going to be much harder to value because of the big legacy investment banking arm it has. I think regulation is helping shape the culture of the business going forward, financial service business. There's no question it needed some reform after the 2008 bear market or meltdown in financial services. And we live with whatever the regulators really tell us to do. And you've got to understand the public reaction to this sort of meltdown in the financial sector. I mean, it's caused enormous anger in 99.9% of the population, and I think they're entitled to feel that regulation is coming in to make it a better sector going forward. I think another of the great fallacies about investing is that economics is important, and if you listen to economists, you would never invest. And you'd miss this big rise in the market. So whenever I'm on a panel with an economist, I keep saying, I don't know, it's a useless occupation, really, except if you're a macro investor in government securities that's got some use. But I think what it does do is when you're looking at a company from a bottom up, you've got to look at the economics of that country, and if an economy is falling sharply or rising sharply, it will have an effect on the domestic stocks in that country. But again, if you take Spain as an example, the economy would obviously affect the banks, but not Zara. So it's a really so you've really got to disregard economics, I think, in investing, and especially bottom-up stock picking. I think the issue with QE is how it gets unwound, because what we've got is this massive injection of liquidity into the economy, with the various central banks buying up large chunks of their own debt to inject cash into the economy for us to invest in either bonds or equities. Now, the downside of that is it's going to take a long, long time to unwind this, and it could take years. So whenever I've spoken to people at the Bank of England and so on, how are you going to unwind this? They say it'll take many, many years. And it will be gradual. So it's not something I really fear, but it is something we should always bear in mind when we're investing in countries. But again, the other side of unwinding QE is the banks will be able to release a lot of the deposits that are held in the Bank of England from the various banks. So in fact, in a way, that there is money going out the other side as well. Yeah, as to first group, I think with the benefit of hindsight, we would have funded the acquisition of Laidlaw differently. We had the chance to raise more equity at the time we bought Laidlaw, but the plan was to sell off a subsidiary, which with the downturn never happened. And as I say, it's easy with hindsight, but we should have raised much more equity at the time of the acquisition, rather than have to do it now in almost a sort of distressed situation.